Hello and welcome to this month's episode of Capital Markets View. November, autumnal, coming to the end of autumn. Still got some leaves on the trees, but kind of like reddy and brown. How are you, Taron?
I'm good, thank you. I just need to make a couple of notes before we start. I just wanted to say that the activities of LCD are independent and separate from S&P Global Ratings. S&P Global Ratings also maintains a separation of analytical and commercial activities, and as was recently announced, LCD will soon be divested from S&P Global.
Lovely, thank you. Right, so let's go to the first slide with data on, which is European monthly new issue leveraged loan volume. Looking pretty good. I mean, we've already discussed the kind of like everybody took a good break in August. I mean, like, wow, that was almost flatline. But September and October pretty strong.
Yeah, I mean, I think the whole entire year has been very strong, and
Yeah.
we might be on track to actually break some records this year.
Yes.
If you look at full year 2007, 2017, it looks like we might match or exceed those at this point. So it's been a really good year for new issuance. Um, but as we talked about before we started recording, there has been an increase in pricing,
Which is
which
our next slide. Average yield to market at issue for single Bs. Yeah, it's still going up, which is strange.
yeah, and David actually wrote a topical looking at sort of price flexes and what was happening as deals were being syndicated. And actually, if you look at the next chart, you
Which
can
is
see.
okay. So we're going to slide 4, which is percentage of institutional flexes.
Yeah, so let's ignore August because August is always just a handful of deals, so the data
Yeah,
always looks a bit
yeah.
skewed. But we're actually at the highest percentage of upward flexes to downward flexes since before the pandemic. So there are a lot of flexes that are happening that are very investor friendly actually, and I think there's credit differentiation that's happening. Some of the smaller deals are having to pay up more, and I think the fact that there has been so much issuance. This is a bit confusing, as we've talked about before, because there is a lot of demand for the asset class. CLO issuance has been very good. We had a record quarter in Europe for CLO 2.0. And if we look at the next slide,
Hang on
which
a
is
second. Let me just one issue that I think is fascinating about that, where you're saying some of the smaller deals and are paying up. So we've talked in the past about direct lending, and it's very difficult to tell because it's a really super private market. But if you're a smaller deal now and you're coming to the public syndicated markets, is that because you can't get a direct lender to give you money and therefore you're having to pay up a little bit in the public markets? Just an idea as to why those smaller deals are having to pay up more.
yeah, I mean, yeah, we are seeing far fewer smaller deals in the broadly syndicated market. I think we've published some data on that. We've written a bit about that, and we're actually going to look at average size of deals for the month end in November because I've had a lot of clients actually asking for that data. I think it is really interesting to see the direct lenders coming more into that broadly syndicated space and for the smaller transactions. So it's definitely something that we should keep an eye on.
Yeah. I mean, we've talked about it, the bottom end of the syndicated loan market being swallowed by the direct lenders. Okay, and so let's pop to slide 5, which is the supply demand balance. And again, you and I talked about this. Big CLO issuance, but pricing's going up. So normally, economics 101, more demand than supply, price should go down, but it's not.
Yeah, and I think that this is where the sort of lower visibility in terms of fund flows in Europe. This is probably the cause of it because we don't know how much is going into the separately managed accounts, the other funds that invest in loans, and Michael actually wrote in the recent global CLO roundup. He quoted Barclays, some research from them that said that they thought that the CLO's market share of all loan investors was going up and not as much, levels were pretty flat in terms of SMAs, other loan funds. So that could be, and we did talk about this last month. The
Yes,
marginal
yes.
investor is are these other funds at the moment, and even though some of the investors I've spoken to said there's been an increase in interest in this non CLO funds, doesn't seem like the inflows have been as strong this year as in years past.
So that's so in other words, CLOs are more there, but there's less managed accounts. So therefore, actually overall, there's actually less demand in the loan space, hence pricing goes up. And again, you and I talked about it'd be really fascinating to dig really deeply behind that because insurance companies and pension funds invest in CLOs, but they're also the people that give money into managed accounts. And is
Mhm.
that a risk shift? Are they saying, actually, I'm gonna buy AAAs in CLOs, and I'm not going to just give money to people to put into single B leverage loans as a managed account. So, the dynamics of what the investors are doing is something fascinating, and I'd love to learn more about that.
Yeah, and I think we're going to talk about CLOs next and the tightening
Yep.
of AAA spreads, and that is because there are more investors going into AAA securities, so that could be like you talk about just an asset shift
Yeah.
into
So
those
let's go on
securities.
to our next slide, which is European CLO new issuance volume. Which is a bit down in November. And I must admit, I've noticed a little bit of a slowdown, but I still think we're going to have a pretty good year. And then, shall we flip to our last slide to rhyme with what you've just said about CLO AAA pricing, kind of stabilizing a bit, and yeah, more AAA investors coming into the market, and perhaps it's this shift of risk going on a little bit, perhaps.
Yeah, I mean, this is the interesting thing is the data is telling us a story, but there isn't as much visibility into this. So we it would be good to know. But yeah,
The low market's a private market.
exactly. Exactly. And also just wanted to mention, I mean, we talked a lot about loans, but in terms of bonds, October has been very busy as well, and there's been a sudden shift into M&A, LBO type bonds, and a lot more single B issuance on the bond side in October. That's what Thomas wrote about in the monthly topical. So that market's been very active, and I think everyone is also looking forward to this Morrison's deal, which we hear will be coming out soon. There's going to be a huge bond and loan, so that will be an interesting one to watch. And also wanted to flag to everyone that I will be doing my default survey as per usual for the end of the year. So please look out for communication about that. There'll be a story and a link where people can put their default expectations in for the loan space for next year.
Cool. And I guess as interest rates start to possibly move up, it makes more sense for issuers to try and fix things. So perhaps more bond issuance.
Yeah.
Lovely. Thank you very much. As ever, if anybody has any questions for Taron or myself, please feel free to contact us. And we'll be back again in December for our Christmas edition. Okay. Thanks very much, Taron. Take care. Bye.